The first half of July has been quite bullish as we continue to press into new all-time highs. But have you ever wondered how July actually ends most years? Not just some vague seasonal trend, but I'm talking real patterns, real data. In this video, I'm going to be diving in to the back half of July using the last 25 years of market history. And I picked out some eerily similar Julys today that we're going to break them down side by side. I'm also going to be giving you the expected moves, the current market conditions, and going through some signal charts on today's video. So without further ado, let's get into it. All right, people, welcome back to the show. I got an interesting show today because I'm pulling charts from basically the month of July dating back 25 years. But then I found some similar type data sets that I kind of want to walk you through, and I'll kind of go through that momentarily. But as you know, July is pretty much one of the most bullish parts of the year. It's a summer kind of rally, hurrah. But what most people don't know is the back half of July can get rather bearish. We typically can see volatility increase, as you can see the seasonality for the VIX spiking here. Now the S&P 500 is floating around right about here at that 6,300, but traders remaining to press higher and higher, reaching out to 6,400 and 6,500. But one thing I did notice is there's not that much going on beneath us. So if you want to be bullish, you really do want to hold above 6,300. In fact, you can see that over here. We have our weekly expected move for the S&P 500 at about 6,350. We almost tagged that today before reversing intraday back into that 6,300. Now, we do remain above that gamma flip line as it stands right now. So that's where dealers look to buy the dip, sell the rip. It's where liquidity increases, which we've been seeing, and volatility typically comes down, which we have been seeing. So when we get back below that gamma flip line, well, that's when things could get a little bit more choppy or volatile in these markets, which I am sure we will touch on when that day inevitably comes at some point. If you look at the daily expected move for the SPY on the 15-minute time frame, we came right into it today. We gapped, we ramped, we camped, and then we sold off towards the end of the day, still finishing up a little bit there, but putting in a bearish type daily candlestick, which we'll show momentarily. Tomorrow's daily expected move is 631.78 to the upside, 625.76. And I went ahead and put in my own expected moves over here based off an IV calculation, going up to and around 634 and 623 to the downside, with the wide weekly expected move for the SPY going from 635 to the up, 619 and some change to the downside. Now, I want to call out too something about these weekly implied moves is it's now been 2 weeks in a row of not tagging. The prior 2 weeks, we exceeded to the upside. So now we're kind of going through that consolidation, which we have been talking about. But this also, to note, is one of the smallest weekly expected moves we've seen since February of last year. So going 3 weeks without touching it would be very impressive. We'll bring that kind of data up the last times that happened if that were to occur. My thought here is that we can easily go for one of those tags. If you're bullish, you want to get back above the week-to-date VWAP and remain obviously above the 5-day moving average. But if we start cracking below the 5-day moving average and it starts breaking down, that can open the doors down to that lower weekly implied move. If we can get back above, well, then guess what? That can set the stage for a rally up to the upper weekly implied move. If we look at back month versus front month volatility, you can see that we're right at about 1.17, so about 17%. Back month is about 17% higher than front month. When you get 20% higher, you could typically get some pullbacks and consolidation. So it's elevated, but it's not quite to those extreme levels as it stands. You can see traders are reaching for protection, hedging here at a skew of 150, and you can see the put to call ratio 10-day moving average is slightly lower than what I'd like to see for a really bullish movement from where we currently stand. But when we start creeping down into this 0.8, that's when kind of everyone's on one side of the boat here, and you want to be a lot more cautious. So as it stands right now, nothing's standing out too much other than the rising skew and just a little bit low there on the put to call ratio. If you take a look here, this is the 4-week rate of change between utilities and S&P 500. And you can see this has just crossed through that positive rate of change, which just tells us the utilities is picking up relative strength versus the S&P 500. Michael Gayed put in a research paper called the beta rotation strategy, and he talks about this in more details. If you haven't seen it, make sure to check it out. But when you do get utilities outperforming the S&P 500 from a positive rate of change, you can see that we've actually went through periods of volatility in the markets multiple times. Okay, so it's not necessarily, hey, an end-all be-all, but what it is telling us is saying basically in short that, hey, when utility starts to outperform the S&P 500, there's a possibility that we might be starting to drive through a storm. And if we drive through any sort of stormy weather, it's not that you can't get through it, but you may want to take your foot off the gas a bit so you don't slide around and do anything crazy or crash your car, if that makes sense. Now, I've shown this chart multiple times. This is the monthly chart of the S&P 500, the SPX, the big product. And what we've been sharing here is the yield curve, the 10-year and 3-month yield curve. And when it's inverted, and when it begins to uninvert, we've shown that multiple times of what has happened throughout history. But then we paired it when we started to cut rates also with the Federal Reserve, and you can see the market presses to new highs, presses to new highs, presses to new highs. We're even at new highs right now. And then when it starts to really crank up, we went in through some financial crises and some spills in the overall market. Now, I'm pointing this out once again because the last time I think I talked about this was actually pointing back to 1998, because everyone was talking about seasonality when we started slipping off here at the beginning of this year in February. And I started calling out, well, the S&P 500 actually did go through a 24% correction over here before ripping to new highs. And that was a seasonal kind of analog chart that I was sharing here, where it was also about a 23 to 24% correction really quickly, but then a very sharp recovery before going through that dot-com bubble. Now, I'm going to highlight some interesting areas over here because we are in that month of July as previously stated. So I went through the prior Julys dating back all the way to 1999, but then I started looking at Julys that were during a period where we were in an inverted yield curve coming out of it. And then we were in this one over here a couple of times, over here. And I found something interesting that I kind of want to share with you. So I'm going to show you those charts and kind of where price was, but I'll start with the S&P 500 right now. So the charts with the blue on the writing over here are the ones that I've highlighted on here. So we're going to kind of go from the right to the left, looking at all these years, but then the blue lines are the ones that I've marked out prior, and I've kind of just found it to be pretty interesting. So first and foremost, we are at July 21st, and we did put in somewhat of a reversal type candle. We saw really bullish. A reverse doesn't mean necessarily anything without confirmation, but it can mark somewhat of a topping candle or a period of consolidation. All right, so if we go back last year, right, not much really going on, right? If you looked at this, just this last year, there was an inverted yield curve over here. But what I did notice here was during that around this same time of year, we did end up going through some volatility before heading higher. Then the next year in 2023, this one, basically, this was where we are basically now. And what happened? Well, we stalled out and kind of went sideways. We had a big up day that reversed completely. So we really kind of just stalled out. The first half of July, very bullish, and then we just stalled out for the remaining of the year. So not necessarily bearish. This is what 2022 looked like. We did come into the 21st, like that's where we are now. And you can see that we just went through a little bit of a pullback before heading higher. Over here, this is 2021, right? We actually had quite a bit of volatility earlier in July, but we're more right here now. And what happened here in 2021? Well, we also stalled out. In 2020, you can see over here where we are now, we basically stalled out with seeing a little bit of volatility. 2019 was one of the highlighted areas, and where we stand basically here right now is right in this area, and we went higher and before seeing quite a bit of volatility pick back up. This was, I believe, during COVID. And then you have 2018 over here. Wait, sorry, 2019. Yeah, 2018. Basically where we stand right here, where we saw a nice snap up, but then volatility came in. So after a very, bullish run, what did we do? We started to stall out. So the first half of July so far has been rather bullish, but then a lot of stall outs overall. Okay. First half of July here in 2017, what did we do right where we are now? Well, we stalled out with seeing some volatility. In 2016, saw a nice big run up. What do we do where we are now? Well, we stalled out, kind of just getting quite a bit of chop here and there. 2015, we rallied up, no surprise. And then where we are right now, we actually did sell off and then saw a little bit of a bounce back here. So some volatility picked up here in 2015, the beginning of, during the back half of that month. In 2014, we saw a little bit of a pop higher where we currently stand, and then some big volatility came in. Over here in 2013, front half of the year, very bullish. What happened next? We consolidated. Now, that wasn't one of the blue ones, but I will keep continuing on to show you these blue levels. In 2012, we actually saw a lot more chop, a lot more volatility, rode up. But where do we stand now? Well, we stand here where it did end up going down before reversing higher. So just a lot of chop there. Same with 2011. Where were we? We were right here, right now, within the month of July, and we did see some sell side activity. 2010, where were we? Right here, we came in, we went up, we went this way. So what did we do basically after the first part of July? We went sideways with some chop. Over here in 2009, first half of July, right, or first part of July, it was a little bearish, and then we rallied. Where are we now? Right here, and then we kind of just stalled out, went sideways, but drifted higher coming out of the great financial crisis. In 2008, first part of July was rather bearish, and then where do we stand now? Right here, where we did see some sideways action with some big volatility. Here in 2007, notice the blue right here. Now, this is where it's kind of interesting, right? Once again, 2007, where do we stand right now? We stand right over here, and this was where we had, obviously, during the great financial crisis, and we saw some volatility there. In 2006, July started off rather bearish. Then we saw some more volatility to the downside, but then we rallied up higher right there. So overall, what happened right at about where we stand now? I would say that that would be a rally, but it was coming off of what? Sell side, which what are we doing now? And what have we seen now? We've seen a big rally. So we got to take that into consideration. In 2005, rally up higher. Where do we stand? Boom. We went sideways and kind of just stalled out. In 2004, July was bearish for the bulk of the first part of the month. And then we, during where we are now, we kind of stalled out and went sideways. In 2003, rally, stalled out, went sideways. In 2002, right, we're talking the dot-com bubble, right? So July started going down. We went down a little bit further to where we stand now, and then we rallied up higher. In 2001, right, during the dot-com bubble, but bursting, we went down, we rallied up higher, and then where we stand now, we saw some volatility, but stalled out overall. And then in 2000, this was also interesting to me. The first half of July rallied higher, right? We got this little reversal type candle, and then where we stand now is right at about here, and we did see some volatility. So, and then if I go 1999, where we currently stand now, about right about here, but we did see a rally, and then we started to see a sell-off. So something that I did find kind of interesting is that during these new all-time highs, right, the new all-time highs, boom and boom right there, while the yield curve was uninverted, I did find that to be interesting how the months of July, let me see if I can pull them back up here, was right here in 2007, right? Very similar. We saw the rally up in July, but then the back half got rather bearish. And then same with the 2000, the front half of July rallied up, but then got rather bearish. Now, the other ones that we called out, so those ones, this was during the kind of Trump first term. And I thought it was interesting to pull out this July here, which was in 2019. So if I go back over to 2019 over here, you can see that we did see a lot more volatility also, but that could be that more that one-off where a lot of that volatility really came from there in 2019. And then I think it was, 2020 when the pandemic hit. So I think that 2019, I can't really remember what was going on, some trade problems. And I know there were some issues going on there before we rallied higher and then obviously sold off. And then the more recent ones here was 2023 and 2024, where we did see the rally higher in the first half of the month, and we did kind of decline there. And then you could see the same thing pretty much here where July rallied and when we stalled out. So overall, what am I picking up on here? Well, I do find it to be interesting that we're kind of in a same type of environment as we were over here in the dot-com bubble, where we kind of just kept on rallying higher. And then we saw July, how it kind of played out to starting to sell off pretty aggressively. And then we started to see a couple areas over here where we did start to sell off, or we saw a rally into the beginning of July, and then we kind of stalled off. So overall, what am I picking up on this? For now, from what I'm seeing for the S&P 500 back month of July, it looks like we're kind of at an area where we're going to either one, stall out, but it could get a lot worse if we start crossing under this gamma flip line. So I'm pulling this video out right now to say just be very, very cautious if we start breaking underneath the gamma flip line and under the lower weekly implied move, because we can see volatility very quickly increase that can bring us potentially even down to a lower monthly implied move or this JPM collar. Now, as it stands now, the bulls have full control of this market, right? We just hit new highs today. That's not bearish. So if the market wants to continue up and hold above this rising 5-day moving average and hold above this gamma flip line, and we just see some, dips here and there, but hold that bullish market conditions, the upside target would be up to the upper monthly implied move at about 64.45 and to the 64.80 JPM collar for the upside. So as it stands now, from where we stand, if I were to map this out, this could be the risk, or that could be the reward, and then the risk could be rather large here to the downside to that long puts of the JPM collar, and then also this VWAP and the lower monthly implied move for the month of July. So the reason why I'm pointing this out once again is because the risk is growing in size while the reward after this rally is shrinking, and seasonality aligns with it. We're starting to see the back month for front month, kind of get elevated here. We see people reaching out for protection, and then also the put to call ratio is kind of sinking. But then also we also have quite a bit of divergences taking place in the market that not many people probably are calling out here. But if you take a look, this is equal weight S&P 500. This is the SPX. We called out this divergence over here, how we put in a lower high and this put in a higher high, and then it led to a market, being sold off. But now look at how equal weight has not made even a new high yet, but yet the S&P 500 has. So either there's going to be some opportunity here, but the longer this divergence holds, the more likely it is that the S&P 500 has to take its time to consolidate or pull back. You can see the value line geometric index, which is another way of looking at equal weight. Big divergence here as well. Big divergence here as well. So very similar to equal weight, but I'm highlighting the other times we saw those divergences and saw the S&P 500 react poorly. The housing market also, remember, if you go back to 2005 where the housing market topped, the S&P 500 went higher, but yet the housing market continued to go lower. And that was a big call out. And you can see even shorter time frames where we've seen bearish and bullish divergences, the S&P 500 sold off, but then also rallied over here on the bullish divergence. Over here, we had a bearish divergence, market sold. And now what do you see? Well, from this high to this low, and this high is making new highs. So the housing market is just not playing as it currently stands. If you look at the summation index for the NYSE, we did start to see the parabolic star uptick just above it, which can identify a potential change in trend. We've had pretty poor breadth here for the last 5 to 6 trading days where the NYMO is underneath that zero line. The NAMO is also losing kind of its momentum here as the market continues to press higher, but the summation index is still currently in a bullish trend with the parabolic SAR just under it. Gold continued to rally, and it saw a nice big uptick today, breaking out of a tighter consolidation. We'll see if this one has any legs and if it's going to go back into that negative correlation with the dollar. Crypto came off the highs today, but overall holding a pretty bullish consolidation. I will say the rate of change between Bitcoin and gold has ticked down here, but it's still holding in that buy signal and buy trigger. The buy trigger was actually right over here. And then after that buy trigger, we did rally. The sell signal was right, I believe, here. And then this trigger took place over here where we saw a quick flush down. And then we saw a whipsaw back into place, putting us on that buy signal. As far as data goes going into the remainder of the week, well, just Tuesday and Wednesday that I had, we do have Fed Sharp speaking tomorrow, hour before the market opens up. Then we have some existing home sales, a couple bond auctions, a couple Fed speaks, some Richmond Fed manufacturing stuff. So not crazy amount of stuff going on here, but we do also have earnings, and we're starting to kind of get into some bigger earnings. I think next week will be the bigger ones, but we do have Tesla after the close on Wednesday, and then also Google, and I'm probably missing a few here. But we do have some more banks like Capital One. We have Intel on Thursday, and well, obviously just a big range of different companies. That's all I got for you on today's episode, everybody. Hope it helps out, gives you some insight. See you on the next.